Sure. But I also wanted to know if there's something extra. Oh no, we good.
Yeah.
Good morning, YouTube. Good morning. How you guys doing?
Yeah, YouTube, how you guys doing?
Good morning, YouTube. Good morning. How you guys doing?
Yeah, YouTube, how you guys doing?
There'll be feedback with that.
Okay, hello everybody, guys, how you doing? Nice to have you in the chat. Nice to have you in the chat. I hope I'm crystal clear. I hope you guys can see me. My name is King. Welcome to everybody just coming into the live broadcast right now. I am an upcoming investor, a student of investment and the likes. So I am learning while also talking and sharing what I've been learning. Okay, I'm in my 30s and I was never an investor. I was never into investment, but I've reached a point in my life where I now see why investment is necessary. Okay, why one needs to invest. So I will be sharing here some of the stuff that I've been learning. So we're just going to be talking about investing. Okay, so there you go. If you can hear me, guys, just kindly drop a comment. If I'm crystal clear, drop a comment and drop a message. Also, guys, please help me with a sub, because this live broadcast, this account is still pretty much new, so I need your help to boost this account. I will be able to read your chats as well. Yes. So let's go, guys. So why should you invest in the stock market? So we're going to be talking about the stock market. We're going to be talking about shares. We're going to be talking about equities, securities. We're going to be talking about investment. We're going to be talking about a lot of stuff, okay? So bear with me. Let's have people come in. There you go. So we're just going to be talking about why should you invest in the stock market. Yeah, there you go. So what's important for you guys to know is why should you invest in the stock market? Okay, do we have any investors who are watching right now? Please tell us if there are investors right there, or people who are trying to get their hand at investing. Please tell me, guys. Okay, let's get it. Yeah. So why should you invest in the stock market? So one of the best tools to grow wealth in human history. So the stock market is one of the best tools to grow wealth in human history. Okay. And historically, if you look at it, you will find out that the market has averaged a 10% annual return on investment historically. Okay, so this is just trying to say that ever since these metrics they started tracing these metrics and these statistics on investment, the market has averaged a 10% annual return on investment. So ROI is return on investment. So there you go. Okay, we see somebody is liking right now. Please drop the comments. So one of the best tools to grow up in human history. So investing in the stock market is just a tool. We all want to get wealthy, and investing in stocks is one of those tools to grow wealth in human history. So I did say the market has averaged a 10% annual ROI historically. Okay, savers are losers. Okay, for all of you guys who have a bunch of cash just lying around inside of a bank account, you will never win the battle with inflation and rising fees and costs. Okay, so actually investing in assets is a better idea compared to just sitting on cash or allowing your cash to just be tucked away in a savings account. Okay, please use that money, invest in an asset or invest in an investment vehicle. Okay, because you're losing purchasing power by not investing. You're losing purchasing power by just allowing your money to stay idle in a savings account. Okay, invest in something and generate more purchasing power, more wealth, more money. Okay, and also the other thing is that recently and now it's never been as cheap as before to invest now. Okay, it's never been as cheap. Previously it was a bit more costly because trading and investing, there are some fees. Even when you're buying stocks, you get levied a fee for your transaction or for trading. But right now, guys, the fees are 0% trades fees or 0% fees or trade fees are the norm. Okay, so right now to invest, to buy stocks, to trade in stocks, there are low expense ratios for solid investments. Okay, you don't have to be a genius. So now, guys, you do not have to be a genius. There are always strategies that help you grow your wealth over time, and that's why we're also here to help you with that. Okay, so let's go. Let's get into the right now. Let's go to the next slide. I hope you guys can hear me though. I hope you guys can hear me. If I'm not clear, please guys tell me, okay, so that I can make some adjustments. Okay. So there you go. What is stock exactly? A stock is a share of ownership in a company. Okay. So for all the people joining or watching us, please make sure that you follow. Okay. A stock is a share of ownership in a company. Think of each share being a slice of pizza. Okay. Think of each ownership. Think of each part of ownership being a slice of pizza. So buying shares, right, gives you equity, ownership in shares of the company. So when you buy shares, you're getting equity, which is ownership in the stocks of a company. So you inevitably become a shareholder. Okay. So for example, we do have Microsoft. Right now we're going to be talking about Microsoft valuation. Okay, so shares outstanding, not currently, but this is like from 4 years ago. So shares outstanding market, Microsoft is valued at, its shares outstanding, its total number of shares are around 7.56 billion. Okay, so this is a large pizza with 7.56 billion shares or pieces. Okay, and the share price for each share in Microsoft is at 216.2 cents. Okay, so market cap, this is sort of like a valuation term. The market cap is the shares outstanding, those 7 billion multiplied by $216.02. So inevitably, the market cap for Microsoft is valued at $1.633 trillion. Okay, so if you are somebody and you own maybe 5,000 shares, okay, in Microsoft, out of those 7.5 billion, or you own 10,000, or you own 50,000 shares out of those 7.5 billion. So all you need to do to know your market cap, to know the valuation of your shares or your share pricing is to multiply that number by 216 valuation. But you do know that these prices fluctuate, right? Probably right now as we're speaking, our share price might be around 220, might be around even 230, okay? Because share prices, stock prices are always fluctuating. So there you go. So companies are typically measured by their market cap. So companies are measured by their market cap. So you can see that in this example, the market cap for Microsoft is $1.633 trillion. Okay, so yeah. So this is a very valuable company. This is a very successful company just by looking at its market capitalization. So market caps, of course, guys, they're subject to changes over time because share prices and shares outstanding can change over time. Okay, so shares are always changing over time. Share prices are changing over time, and also what shares outstanding can also change over time. Okay, maybe shares outstanding can be 8 billion, you never know. We have 2 people watching. So yeah, buying and selling a company's stock drives share prices. We all know this. So welcome, I see 2 people watching. Guys, make sure that you follow, make sure that you share, make sure that you comment something inside. Welcome to our investment live stream. I'm your host Z. I've prepared for you a PPT right here. We're just talking about stocks and investing in general. Please give me a sub, guys, and stay along. Drop your comments so that I can read your comments. So we move on to the next slide. We are now on the 3rd slide. Why do companies issue stocks? Okay, so you can treat this live show as a tutorial. You can treat this live show as maybe information. You can treat it as a discussion. Okay, so why do companies issue stocks? Okay, we want to know. Corporations issue stocks to raise money for their businesses. Okay, that's all it's about. Corporations, companies are in the business. Okay, they're doing business, but they're in the business of raising money. They're in the business of making profits. Okay, they're in the business of opening new businesses, of expanding or venturing into new projects. So corporations issue stocks, or part of their ownership. Stocks are basically part of a corporation or a company's ownership to raise money for their business. So they want to raise money and they want to avoid lending institutions, to avoid fees and high interest rates, okay, on lending. So they offer an IPO, okay? They sell shares or part of ownership to raise money for their business, okay? Their business raise money for what? Maybe they want to fund a new project line. Maybe they want to increase their research and development. Maybe they generally just want to invest in growth. Maybe they want to pay off a debt, an outstanding debt. So they have to sell part of their ownership to you guys, to people we call investors, and the money that investors use to buy those stocks, this is what the corporations use as capital to fund those new projects, pay off debts, and the likes, okay? So we have 2 common stocks. We have 2 types of stocks. Generally, we have preferred stock and common stock, okay? Preferred stock and common stock. So preferred stock have no voting rights. Common stock have voting rights. So you are usually buying common stocks when buying stocks. Okay, so if you decide to go today and buy Microsoft stock, Google stock, Alibaba stock, Tesla stock, if you decide to buy right now, those are more like common stocks, okay? So common stocks, yeah, these are what you buy and hold on to them while anticipating long-term growth or capital appreciation or things of that nature. Those are common stocks. But the thing with common stocks, they have voting rights. People who are common stockholders in any company, they have voting rights, and these voting rights give them the power and the mandate to vote the representatives of the board of directors. The representatives of the board of directors play a crucial role. Their job, number one, in some of these corporations is to give them the power to execute things like what we call M&A, mergers and acquisitions, and other responsibilities as well. You also get a dividend, which is a payout, but with common stocks, the thing is that in the event of a crash or a business doesn't go according to plan, or in the event of liquidation, common stockholders are the last in line to get paid, okay, or to get the investment bank. They're the last one to get paid dividend, okay? So there you go. That is that. Do you guys understand? Please drop a message. Please drop a comment. How are you guys doing? So let's move on. How are stocks categorized? They usually categorized large cap, mid cap, small cap stocks, okay? So remember, cap, market capitalization. This is how companies are valued. Okay, market cap is measured. Okay, this is how companies are measured in terms of market cap. You can go check out the first slide. So we've got large cap stocks, mid cap stocks, and small cap stocks. Okay, there you go. Market cap. We did the calculation. We found out that it's what? It's shares outstanding and shares price. So that is the formula for market cap, shares outstanding. You can go check out the first slide. There is a breakdown of market and an example of market cap. Okay, so large cap stocks are companies that are valued at 10 billion plus market cap. Okay, these are typically hard to achieve massive growth due to size. They become typically hard to achieve massive growth due to size. Proven track record over many years. Frequently offers dividends. Okay, the proven record, the valuation is 10 billion going upwards. So they have a proven track record with their investors and with their business ventures. Okay, so you can see why these companies are big. For example, Microsoft. There you go. Their market cap is 1.633 trillion according to this example. Okay, so you can see there you go. And also we do also have mid cap stocks. These are companies that are valued from 2 billion to 10 billion in terms of their market cap. Not quite large cap, of course, you can see the figures are different, and more established track record than small cap. Okay, they also have a degree or a level of track record. Okay, between 2 to 10 billion. Come on, but they're not as big as the large cap. Often target of M&A. Okay, they often target. So mid-cap companies are often the target of what we call mergers and acquisitions. So usually the large cap are actually usually targeting the mid-cap to merge with them or to acquire them so that they become part of the large cap. Okay, so this is business cap. So also have small cap. This is between 300 million to 2 billion market cap. Typically younger and are seeking aggressive growth. These are your new startups. Their valuation of their market cap is between 300 million and 2 billion. They're typically younger. These are startups and they're seeking aggressive growth. Yeah, they're seeking aggressive growth in terms of their business. They're seeking aggressive growth in terms of their business model, their products, their services, okay, and also the market share in whatever market they operate in. Okay, so there is usually high risk because there is no proven track record, so there's usually high risk and don't usually offer dividends. Usually when they start, when they're still small, they're not usually offering dividends and they're kind of like high risk. Okay, so there we have it. Okay, there we have it. So you guys, how are you doing right now? Okay, I hope you guys are doing good. Okay, there you go. Let's continue with the live broadcast. Okay, there you go. Let's go. So let's move on to the next large cap, mini cap. We did talk about that one. How stocks categorized. We're going to talk about this. Okay, how stocks categorized. We are continuing. So we have what we call growth stocks and income stocks and value stocks. Okay, growth stocks and value stocks. If you're watching right now, guys, please make sure that you follow. One person is watching. That's good. So let's continue. Make sure that you follow. So growth stocks, big potential for growth, outpacing the market. Amazon, Facebook, Microsoft. Okay. So there you go. These are those large market cap companies that we just spoke about. So the stocks that are in those companies are known as growth stocks. So big potential for growth, outpacing the market. Your Amazon, your Facebook, your Microsoft. Okay. Typically, sometimes low, sometimes no. Typically low or no dividends. Okay. So whatever the earnings that these large cap companies get, or that these large growth stocks have, whatever earnings they have, it is channeled back into the business for reinvesting purposes. Okay. So they're always reinvesting whatever profits, whatever earnings they get. Their main aim is to always to keep on growing. Okay. So these ones, they grow at a very fast and exponential rate. That's they called growth stocks. Then we have income stocks. Okay, regular dividend payment or regular dividend payout. Okay, regular dividend payout. Income stocks. Okay, regular dividend payment or regular dividend payout. Okay, regular dividend payout. Okay, there we go. So let's move on right now. Income stocks, regular dividend payment. We're talking about your Walmarts, companies such as that. They have a proven track record in a business model, consistent increase in dividends. Okay, so income stocks, you get a dividend. A dividend is basically a part of the profits that you get paid out by the company because you own stock in the company. Okay, so picture it like a tenant, a landlord and a tenant kind of relationship. Okay, so the tenant pays the landlord. Okay, so you're sort of like giving them a dividend. Okay, or you're paying the what? You're paying the landlord, always giving them up a dividend for staying there. Okay. So in this case, the tenant is the stockholder is the tenant, and then the stockholder is the stockholder is the tenant, and the company. The stockholder is the landlord, and the company is the tenant. Okay, so they always give you that little There you go. Okay, we also have value stocks. Perceived to be trading below its fundamental PE ratio, okay. Profit and earnings perceived to be trading below its fundamental PE ratio, typically seen as unfavorable in the marketplace. Okay, they're seen as unfavorable inside of the marketplace. There you go. No one likes them. Okay, so there you go, guys. Let's move on. Let's talk about how are stocks categorized, and let's talk about some of the common stock sectors. Okay, stock sectors, an area of the economy in which businesses share a product or service. Okay, then there are 11 broad sectors. Okay, in any economy, in any country where you go, you're likely, especially in the developed world, you're likely to come across these 11 stock sectors. Okay, there are 11 broad sectors. So we have energy. When we talk about energy, we're talking about our oil industry, we're talking about our gas industry, we're talking about our coal industry, we're talking about fuels, yes, bioenergy and the likes, etc. Then we also have got what we call the materials sector. Now we're talking about chemicals, also metals and paper. Okay, I think you know some companies. And then we also have what we call the industrial sector. We're talking about defense, aerospace, manufacturing. So we're not talking about your NASA's. We're not talking about all of these Boeings. We're also talking about defense. We're talking about manufacturers manufacturers of weapons, of weaponry, things of that nature. So these are what we call industrials and manufacturing. Okay, and also we're going to talk about the other one. Number 4 is consumer discretionary. So all these are sectors where you can invest in. Okay, consumer discretionary. We're talking about apparel, household products, etc., consumer staples, food, beverages. These are your Coca-Colas, your McDonald's, your Walmarts, your supermarkets, okay, stuff like that. And any people that are into food and beverages, you know some of the companies. We're now talking about your Pfizer's, healthcare, Pfizer's, and all these other companies that's pharmaceuticals and healthcare equipment manufacturing companies, okay? We also have financials. Now we're talking about banks, okay, information technology, a sector, internet, software, semiconductors. You guys know all these companies that are into internet and software. Telecommunication services. We got your AT&T, Verizon, etc. We can also throw people like Microsoft in there as well, in IT and the likes. Utilities. We're talking about electrics, gas, water companies, and real estate, okay? Real estate, we're talking about REITs, okay? Apartments, malls, office space, etc. Okay, so these are stocks, okay? So understanding risk. What is risk? So risk, okay, so remember guys, it's investment. Investment is not a walk in the park. There is this thing that I have to break down, what we call risk. Okay, so what is risk? Okay, what is risk? The chance that your actual outcome will differ from your expected outcome. So it's a chance that your actual outcome will differ from your expected outcome. Okay, so that is what we call risk. So risk includes the chance of losing some or all of your investment. That's the downside of risk. Okay, you may lose your investment, all of it or some of it. This happens. Okay, so risk should be your reward. Okay, risk should be the outcome, what you get for investing. Okay, as investors, we are compensated for the level of risk we assume. So people who assume minimal risk may also get minimal rewards. So people who go for the higher risks may also get higher rewards in turn, whether good or whether bad. Okay, so that is what investing in a startup versus in a savings account. Okay, so both of them have risks. So what risk is carried? You might be, the startup doesn't have any track record, so let me take my money and put it in a savings account. And then after a while, people who invested in the startup, that startup has a good valuation or a higher market cap, and people who invested are now worth a lot of money, or they own a lot of assets, or their stocks are valued at a price, or probably they encountered or experienced 100-fold in terms of value of the stock, and unlike someone who just put their money in their savings account, and you're gonna start regretting, like, I should have invested in a startup. And also you can invest in a startup and it flops, it doesn't turn out you lose your money, or somebody would have put their money in a savings account and they still have their money. So it's always about your willingness to risk, okay? Compensate for the level of the risk that we assume. Okay, understanding risk. Okay, continued. So there is market risk, liquidity risk, concentration risk, credit risk, inflation risk, or rising risk, foreign investment. So market risk, these are economic developments or other developments. Okay, like for example, in the 2008, the economic crash. So that is what these are economic or market developments. So these are market risks, and usually with market risks, sometimes they affect everybody. Let's go back. You see, all these sectors might be affected by market risk. Okay. So all companies in manufacturing or in real estate might be victims of what we call a market risk or economic developments. These are things that are beyond our control, and many other events. Then we also have what we call liquidity risk. Okay, liquidity risk is the risk that you take. Okay, you have an investment, but you cannot sell it. Maybe you invested in something. Maybe you invested in a barn, or in a warehouse that is in the middle of a cornfield. But what are the chances of you finding a buyer or you selling that investment to someone based on its location? Okay, so then that liquidity risk, and will you be able to sell your investment? Will your investment be able to get a buyer? Okay, yes. There are a lot of people who are willing to buy a barn or a warehouse that is in the middle of a cornfield, or are they willing to buy a warehouse that is at the top of a mountaintop or in a remote area? Okay, so that is the liquidity risk. We also have concentration risk. This is having your investment in one place. Okay, concentration, too many eggs in one basket. Maybe you've got a similar type of stock. Okay, maybe your stocks are just one type. Okay, or maybe you just have your investment. Your investment is concentrated in one industry. So that is your concentration risk. Okay, we also have credit risk. So this means like the risk you run when the company that you own equity in, or the company that you have securities in, cannot be able to pay its creditors, right? Cannot be able to repay their loans, their debts. Yes, so there's also that credit risk. This is not on you, but this is on the company that you have an investment or equity in. So when they fail to do that, to pay up, and there's liquidation, so that's what we call credit risk. Okay. There's also inflation risk, which is the loss of purchasing power. Okay. And we also have what we call horizon risk. Okay, your investment time changes. We also have horizon risk. Your investment time frame changes. Okay, your investment time frame might change. Maybe you did put an investment down, and something happens, and then it doesn't pan out like we wanted it to. Okay, you fell sick and you had to sell your investment so that you can get funding or money for your to cover your hospital bills, or to cover your medical bill. So that just means that is your horizon risk. Okay, your investment time frame changes. There are things that will happen that may cause you to change your investment time frame. Okay, then there is also foreign investment risks. These are now applies to foreign investments foreign markets. I take my money, I buy stocks. I go to buy a startup in South Africa or a startup in somewhere else, and then it doesn't work out there, or the government there shuts it down. So that is what we call foreign investment risks, and I never get my money back. So these are the 7 types of risks that are involved, especially when you deal with stocks. Okay. So any questions, guys, please feel free to tell us. Any questions that you have, we will help you, okay? Okay, there you go. There we go, guys. Feel free to share. Feel free to stay inside of the live broadcast. How many people do we have right here? Should I continue, guys, or should I talk about something else? Okay, tell me. Now let's move on to the next. How many people are watching right now? Are you guys watching? Let's see. Okay, only one person watching. Show us some love. Okay, let's move on. So we have types of stocks, equities, what to buy. So types of stocks, equities, what to buy. So you can buy individual stocks. These are some of the stocks that you can buy. You can buy mutual funds. You can also buy index funds. You can also buy exchange traded funds, or you can buy REITs. Okay, real estate. Okay, REITs are real estate investment. Yeah, real estate investment trusts. Okay. Real estate investment trusts. These are what we call REITs. Okay, so these are some of the things that you could buy. Okay, now let's go. Types of stocks, equities, what to buy, and we're gonna get into a lot of calculations later. So what are some of the types of stocks to buy? Okay, so types of stocks, equities, what to buy. So we're going to break down these ones, guys. Individual stocks, mutual funds, index funds, exchange traded funds, and REITs. Okay, so let's break them down a little. Okay, so types of stock, equities, what to buy. So we have individual stocks. Okay, so now we're talking about individual stocks. So you can see there's a diagram there. We do have all of those companies where you can buy maybe individual stocks from. We got your Walmart. We have your okay, you have your Walmart there. I hope it's clear. And then individual stocks, pros are reduced, no fees, okay? So usually with individual stocks, there are not much fees to pay, okay? Or trading fees or whatever. No management fee to own. So there's no management fee because there's no one who's managing this for you, okay? It's totally in the management of the company. So management fees to own them, or you do not have to pay any management fees, okay? Complete control, understanding of what you own. Okay, so you know how many stocks you have, so that is complete control. Taxes are easy to manage. Okay, capital gain loss. Okay, so let's go for cons. Taxes are easy to manage. Capital gain, capital loss. Cons, hard to diversify. Need 20 to 100 to achieve adequate diversification. Yeah, might be difficult for that. If you want to diversify, you gotta look for a lot of companies. Okay, And also more effort, time to monitor portfolio rebalancing ECTs, and also emotions and fear of the moment. Okay, fear of the moment. Okay, so so now we go with types of stocks, equities, what to buy. So mutual funds. Mutual funds, guys. This is the next set of investment. So mutual funds. Okay, there you go. So mutual funds. This means pools of money from the public to buy securities. Okay, that's what mutual funds means. These are pools of funds of money from the public to buy securities. Pros are they're liquid, okay, they're highly versatile, they're liquid, they're diverse, okay, professional management, active versus passive, lots of options, balanced, fixed income, money market income, etc. There you go. So you have a lot of options with these ones. And there you go. Cons are higher fees. Yes, no FDCI insured. Large cash holdings. So it's just money that's held up somewhere and subject to inflation. Okay. Hard to evaluate in terms of apples to apples. Okay. So there we go. Let's move on to the other one. Types of stock, equities, right? What to buy. So now we talk about what index funds. What are index funds? This is a basket of stocks to mimic a certain market index. Okay, it's a basket of stocks that mimic a certain market index. Okay, pros, low fees involved with these ones. Outperform active management over time. Easy to own, manage, invest in, and achieve goals. Okay. The cons are no control over holdings, lack of downside protection. It's not a hedge fund, so it's not hedged. There is no protection at all. Lack of different strategies. Yeah, lack of different strategies as well. There you go. So now let's go to the next one. Types of stocks. Okay, we're going to be talking about some types of stocks. What to buy. Okay, ETFs. Okay, we want to talk about ETFs. Type of stock. ETFs, basket of stocks to mimic a certain market sector that trade on an exchange. Okay, so these are traded on a stock exchange. It's a bit different from this one. This one is just to mimic a certain market index. Basket of stock to mimic a certain market. This is mimics a certain market sector. Remember we talked about market sectors, 11 market sectors that we did speak about. That trade on an exchange, okay, on a stock exchange. So access to many stocks. Yeah, this one is good because it gives you access to many stocks. So it might be one stock, a basket of stock. It's one thing that will have a basket or a myriad of other stocks. Okay, imagine you buy one stock and in that one stock you have many other stocks. Okay, so this is what ETFs mean. Okay, and low expense ratios. Yes, also has low expense ratios. Easy to own, manage, invest in, and achieve goals. Okay. And what are the cons? Cons, actively managed ETFs have higher fees, lack of downside protection as well. They're not hedge funded like the previous one. Diversification is limited by focusing on one industry. Okay. Now let's go to the last one, types of stocks and equity. There we go. We are on our last slide. Then we give it a go. So, right about now, we're now going to talk about real estate investment trust. That's what REITs mean, okay? Real estate investment trust, a company that owns, operates, or finances income-producing real estate, okay? Income-producing, we're talking about these malls, these apartment buildings and stuff like that. So it's a company that owns, operates, or finances income-producing real estate, okay? So pros, okay? Pros, access to a historically unaccessible asset class, okay? Real estate. We're going to talk about also, it's pretty much liquid. It's also stable cash flow through dividends. Have to pay out 90% of income, okay? Yes. Historically sound asset class, because you want to invest in something that is historically has been proven to be sound. It's got a long history, you know. It's not as volatile as other markets, okay? So there you go. And now we're gonna watch cons. Dividends are taxed as regular income. Dividends are taxed as regular income, subject to market risk, economy downturn. Like in 2008, there was a lot of stuff. This happened to a lot of people, and a lot of people drank themselves to death because of what? Market risk. Okay, so real estate is liable to a lot of subject to a lot of market risk. Can have high management fees. Okay, so next time we're going to be talking about financial ratios when buying stock. These ones require more of a showing you guys how to do it and the lights. Okay, so what it's gonna be? Okay, let's see. So there we have it, folks. Today was the that's what I had for you guys. It's 47 minutes with you. So thank you a lot for tuning in, and we will see you next time. Yes, we'll see you next time, guys.